Jay, you nailed it last time you were on in November of 2020, and you set the stage for us very, very clearly. You gave us some really, really great advice. You said follow the Fed. That was fantastic and spot on. You made some very good comments about interest rates and very good comments about what would happen after the election, so on and so forth with the markets, and everything's really played out perfectly. So I guess I'd like to begin by asking, what are your thoughts on the current market and what do you expect going forward?
Well, I think the current market's a little dicier than last time we spoke because we're clearly closer to a Fed taper than we were last time, particularly given the fact that we printed very hot on inflation, which was what we had been predicting at the beginning of the year. But what seems to be clear, at least for now, is that people aren't going to leave the party until the Fed actually takes the punch bowl away versus they fear that they're going to take it away.
Right.
So, and that normally, those type of fears normally, and even if the Fed hasn't acted by them, come into play in the normal panic time of the fall, when you have a big gap between the earnings seasons during the summer and the fall. You're not into kind of year-end window dressing. So I would be a little bit cautious when we get to fall, but it's important to kind of listen to the market. And the market certainly is giving zero signs that it has a big concern about the inflation or a near-term taper. If they did, like the market was off by about 15 handles for about 5 minutes after that inflation report. So if you don't listen to that as a sign, or particularly if you're a trader but just trying to get your kind of intermediate term portfolio positioned, I would just have to listen to the market where it seems like it wants to be stable to go up and ignore this inflation for now.
And what are your thoughts on that? I know inflation, the Fed said they want an average of 2%. Right around when you were on, the Fed changed their stance from a target of 2% to an average of 2%, which means they'll let inflation go a little bit higher. Now that we've seen inflation come in much higher, and 5%, and who knows tomorrow with PPI, but we've got much higher inflation. Do you think that will impact the Fed's decision on when they taper and how fast they taper? Or do you think it's transitory, like the Fed is saying that don't worry, this is just a one-off and it'll pass?
Well, the strange thing about the transitory notion is it could be transitory if the Fed tapered.
Right.
So it's a very, very odd construct that they've never used before. But the key facts to keep in mind is the Fed increased the monetary base. So it's basically money. So and it's simple to measure because you can see it on the Fed's balance sheet. So monetary base is just currency plus reserves.
Right.
And so that, Milton Friedman would tell us, so they increased it 50% the last year. And then just because of the laws of arithmetic, if they keep doing what they're doing, that's going to be 30% next year.
Right.
So maybe Milton Friedman is kind of mostly wrong, and we're not going to get 30. But, at the extremes, like if Argentina doubles their money supply, they're going to have like 95 to 105% inflation.
Right.
So I could buy into transitory if they stopped QE. They don't have to raise rates, but stop QE. So we're extremely concerned about inflation, and not just because of the quantity theory of money, but also we watch oil. And the insight that most people have missed is that if you're committed to reducing climate change and reducing carbon, the only real way to get there is much higher oil prices or energy prices, either through a carbon tax or by restricting production. So we're restricting production globally through the capital markets and regulation in the U.S. and elsewhere. And so if we have much higher commodity prices, that does bleed through to core. So we're bearish about oil's impact on inflation, and we're bearish that you can increase the money supply at over 30% a year and have 2% inflation. You might have 5. Again, Milton Friedman would tell you to have 30, which doesn't seem like it's going to happen. But we have a potential for hyperinflation if the Fed doesn't back off. Mm-hmm. So I think it's inevitable they will. And I don't think the market's going to love that. But I don't want to get out of the market because an asteroid's going to destroy the Earth in 1,000 years, if that were true. So we've got that's a long period of time, and it's a long period of time between now and the fall. So I think that we'll have some period of volatility, but that's kind of always true.
Yeah, that's a great point. So you said you're bearish on oil. You expect oil prices to come down?
No, I'm sorry. I kind of had to
Yeah, that's what I want to
I mean, I'm bearish on oil's impact on inflation. Like,
Okay.
I think we're headed to 80 with it. If there's a supply disruption, potential for a super spike.
Yeah.
Tudor Jones is on this morning kind of describing that, if there's any reallocation to commodity funds, everybody who creates commodities is a momentum trader. So if we go to 80, you might go to 100 just by commodity funds.
Right.
So the risks are to the upside, which is bearish for inflation, or in other words, inflation can go higher. So I said it in an overly complicated way.
I thought that was the case. I just wanted to clarify it for the audience. Okay, that's fantastic. So assuming that the Fed does taper, what are the impacts on interest rates, and what are your views on interest rates in general?
Well, we were talking about before we started that it's a little bit nuanced now because you had the Treasury sell off hard into the first quarter. But what we see as the constraint is there's kind of a maximum differential. Treasuries are one of the most global securities of all, because every central bank really holds treasuries and holds a lot of other sovereign bonds. So they're not just looking at the Treasury like we might, because we're US focused. They're saying, well, do I want a Mexican bono trading at over 3%? Do I want a risk-free rate in the United States of 150 or 160, 170? Or do I want bonds at negative 25? So they're kind of negative. The Bund is probably the most relevant benchmark to U.S. rates,
which is the German, German Bund, just to be clear.
Yeah, German Bunds. So or treasuries, if you want to call it that, their treasuries. So we're right now at 175. That maxed out at kind of 180. So we see that as an anchor to U.S. rates, but the European Union is rapidly catching up to us in vaccinations. Their virus rates are plummeting, except in the UK, there's a little bit of an uptick, but everybody else is plummeting. And so it's inevitable they'll recover sometime during the summer. Their rates probably will rise, which would cause our rates to rise. And then we see inflation more accelerating than tapering, and then or attenuating, and then the Fed taper. So all those would argue for higher rates.
Okay.
So that's kind of our base case. But same thing with the stock market. Right now, treasuries seem to be pretty range bound. So I would wait to put on any trades that are directly related to that. But that's one reason why I think, we talked about it last time we were on, and always really talk about investors. We like the preferred stock asset class because you're senior to common, so you can afford to be pretty wrong about a lot of things and still make money. Whereas with equities, they're much more volatile, and the cash flows aren't senior to common, so they can be suspended. So we like that preferred asset class, particularly in times like now where things are a little bit dicier than they were 6 months ago.
Yeah, that's a great point. So now that we're speaking about preferreds with higher interest rates, how does that impact the preferred world and people that are looking for dividends or yields or distributions or anything along those lines?
Well, generally preferreds are attractive because we think that the rating agencies maybe overpenalize for good credits because of the theoretical time when there's a bankruptcy.
Right.
But if you think most large issuers of preferreds, that they're going to do everything in their power to avoid a bankruptcy, unlike maybe a private company that's run by a private equity firm. Mm-hmm. So there's a 2-notch differential. So even investment grade preferreds, a lot of them are yielding right around 4. That gives you some insulation against rising rates, but not that much, just because their spread over over corporate bonds is pretty high. But where you get total protection and actually upside, because we do think preferreds are still, non-investment grade preferreds are still undervalued, and that's what you've seen so far this year, and I think what we predicted last time we were on, is that in a rising interest rate environment and a stable to rising stock market environment, the crossover non-investment grade preferreds tend to outperform the investment grade. Kind of the investment grades are more likely to be flattish, again, because they have the spread relative to corporates, but the other bonds or preferreds rather be up. And that's what you've seen, where the non-investment grade asset class in preferreds has dramatically outperformed investment grade. So
that's really fascinating. So how do you value, Jay? Sorry to jump in for a second. Whether a preferred's undervalued, or if it's fairly valued, or if it's overvalued?
Well, we have a peer So that we take the our credit rating, our own assessment of the credit rating, which is usually pretty close to the stated credit rating, although a lot of them are unrated. And then we look at a fair spread over treasuries, and look at the whole universe. And then we tend to eliminate, because we are concerned about interest rates, we tend to eliminate the really high credit, low spread preferreds that are yielding less than 4, because there you have more interest rate and risk and less potential for spread compression. Mm-hmm. And so then we look at which preferred is the most attractive, and most importantly, and something that can be difficult for retail investors to analyze, is that we look at yield to call. So if securities are trading above par and callable, well, they're almost all $25 pars or stocks are preferred stocks are callable. So then we then analyze yield to call, because of course you lose money if it gets called at 25. So we look at it on a yield to call basis. So it is a little bit complicated. And then of course we eliminate securities where we think there is real bankruptcy risks. Like for instance, Washington Prime Group filed for bankruptcy today. They have a preferred. That preferred could very well get wiped out. So we would not consider those type of securities. So we like depressed, but not distressed. So distressed being, we don't think there's any chance of bankruptcy, or when there is a chance of bankruptcy, that's distressed. So that's important, is to put a credit screen on there, because you do not want to be doing distressed preferred stock investing, in our opinion.
No, not at all. So depressed companies would be companies that are pretty much not going to go bankrupt, but they're trading undervalued, or they're attractive levels. The distressed asset would be a company that could go bankrupt, but you don't want to touch those, because if they do go bankrupt, you get a goose egg type of a situation.
Exactly. I mean, sometimes you get lucky. I mean, certainly, I mean, utilities are phenomenal. I used to be a utility investment banker. They're phenomenal credits. So Pacific Gas and Electric can go bankrupt because they have regulated assets. The preferreds are, money good, but that's the exception that proves the rule. In general, the preferreds get lumped into the equity, and maybe they get a few options or something, but it's kind of a de minimis situation. So that's the reason rating agencies do double notch them, or triple or quadruple notch them for lower credits.
Right.
So you do want to avoid them in that case where there's that bankruptcy risk.
No, that makes perfect sense, because I know value, like beauty, is very subjective, and everyone's got a different way of looking at things, whether they're overvalued, undervalued. So thank you very much for that answer. That's fantastic. So as far as the investor's concerned, they're looking at the world now. They see interest rates are going up. The Fed may begin to taper at some, when, not if, right? They're going to beginning to taper at some point. If the Fed tapers faster than expected, what are your thoughts on the ramifications for the markets with an S? And how do we, navigate that kind of scenario? And then if they taper lower or slower than expected, how do we navigate that scenario?
Well, what we've really had most of this year is an upward trending market with a ton of rotation. Yeah. So generally speaking, in markets where rates are rising and there's a fear of a taper or higher inflation, tech stocks underperform, value stocks outperform because they're levered to inflation. Mm-hmm. And so, unfortunately, if we had a kind of a surprise taper, I think unlike this year so far, we're likely to have a declining market. Unfortunately, some rotation, so tech maybe underperforms. Some of the stocks like Boeing or other recovery stocks that haven't gone back to their highs. Some like hotel companies are above their pre-pandemic highs. They might outperform, but maybe still drift down. And then a mild taper, conservative, then it's sort of anybody's guess whether which side of the boat people are going to be running to, whether it's to tech like it is today or to value stocks. But so we when it comes to the equity markets, recommend just having diversified portfolios, and have some of the higher quality growth companies, the FANGs of the world, and then also have good recovery stocks, so that we can kind of take advantage of the volatility and the rotation rather than being hurt by it.
Gotcha. So I know that you're big with PFFR on REITs in general and preferreds on REITs. What brought, just in general, what attracted you to this space? And can you explain a little bit for the audience why that's an attractive area to invest their money?
Yeah, so as I mentioned already, the thing that a lot of people don't appreciate is that preferred stocks are senior to common. So you get paid, and a lot of them are cumulative, over 50% of them are cumulative. So you get paid before the management team gets paid, because they almost never own preferreds, but they own a ton of common.
Right.
And the board members, for that matter, oftentimes get options. So that's a good to great place to be, which we saw during the pandemic, where we had a lot of common stock dividends were cut or eliminated, but the preferreds continued. And the reason for that is that kind of twofold. One, they can be cumulative, so it doesn't really save you any cash if you assume you're ever going to have a dividend again.
Right.
And two, it looks terrible to stakeholders, looks bad for the rating agencies, regulators, customers, counterparties. So there's a huge tendency for decent credits, again, not companies that can go bankrupt, but for well-established publicly traded companies to continue their dividends and issue equity, sell assets, or whatever they need to do to improve their credit. So generically good, we think a good to great asset class, and one that's under-owned. We think that most retail investors tend to under-own senior to common, under-own bonds, for good reason, maybe regular bonds, because you don't get any yield. Because it's important to balance out your portfolio and have something that you could potentially sell if the market was way down. So preferreds in a normal market are less volatile. And then also the reason that we have liked REIT preferreds is we actually did very well in the last, not pandemic, but in the financial crisis, buying REIT preferreds, because they weren't in the blast zone. Financials were in the blast zone.
Right.
But yet all retail investors, or most retail investors, sold them in a panic. And then we analyzed the real estate and said, well, wait a minute, a lot of these preferreds are actually backed, in effect, backed by unlevered real estate, which is kind of a great place to be from a credit environment, because most REITs are meant to be full cycle because they're underwritten by investment banks and they don't want to hurt retail investors. So unlike a building that could be 80, 70, 80% levered, REITs are normally about 40% with bonds and then have preferred. So the preferreds kind of attached at about 50% of the value of the real estate. So you have to have a god-awful decline in the value of the real estate,
right?
Which isn't super likely, because real estate can be repurposed as well, because a lot of it's land value.
Right.
So like I'm in an office building in Manhattan, actually it's pretty well positioned, but if it weren't, it could be turned into a hotel, it could be turned into condos, and there's a lot of land, it could be demolished and land sold. So
right.
It's not that common that you have that kind of impairment. So we think that REITs are generically good credits.
Got it. And then for savers or people that are looking for extra yield or to help diversify their portfolio, can you speak a little bit to the importance of having a diversified portfolio and what thoughts you have around properly diversifying your portfolio?
Yeah, so it is a little bit disturbed right now just because rates are so low. So normally the kind of generic advice is that you have some of your portfolio in bonds kind of equal to your age. So if you're 20, you have 20% in bonds. I don't think any 20-year-olds have any bonds. I'm not sure they know what it is, but still a good policy to have. And of course, part of the reason is that investment grade bonds, I mean, a lot of the asset class that would be in a fixed income portfolio are pretty unattractive. They're kind of risk-free, return-free risk. So, munis, investment grade bonds, mortgages, treasuries, you're really just yielding kind of 1%, 2%, and 3%. So it's understandable that you wouldn't have a huge allocation to that. But so preferreds and high yield bonds, they tend to yield more like 4 to 5 right now. So those can be an attractive way to balance out your portfolio partially, not as well as treasuries. So in a down market, preferreds and high yield bonds, they'll probably, not a pandemic where everything gets liquidated and not financial crisis where everything goes to 1 as a beta, but in a non-liquidation decline like we may have later this year if there's a taper, or next year if there's a taper, then in theory at least, preferreds and high yield bonds would only go down, say, 25% to 50% as much as your overall portfolio. So you could use that as a source of funds and say, oh, well, my high yield bonds held up pretty well, my preferreds held up pretty well, so I'm going to sell a little bit of those, maybe not all, and I'll buy some Apple, or I'll buy some others, blue chip Dow type stock.
Right.
It's down a lot. So you can use it in your portfolio to rebalance. And then, of course, we only really traffic in yield securities. That's another way to reduce risk, is if you have a 3, 4, 5% yield, then you shouldn't, unless you really need the money right away, shouldn't care as much about a decline, because you can just reinvest the dividends at a more attractive yield. So those two combinations of having significant yield and having other non-equity asset classes can allow you to take advantage of downturns versus just being disadvantaged by them.
That makes perfect sense. And then during the downturn, when you take advantage of it, would you increase your allocation to X, Y, or Z, or do you recommend keeping that traditional allocation?
Well, see, that's what's nice. I mean, you could, if you want to make a judgment and say, well, instead of being, let's say you're 50 and you're 50% bonds and 50% equities, if you just mechanically rebalance, then you end up normally selling high and buying low.
Right.
So if the stock market's way down and your bond portfolio is outperformed, you just rebalance to 50%. But there could be times, like if you thought that, like March of last year, when the Fed intervened and said they're going to buy like 3% of the capital market every year, that might be a time to say, well, wait a minute. Yeah, I know I'm 50-50, but this seems like an unusually good time. So I'm going to rebalance to 55% equities and 45% bonds. So you could use some judgment, but I would think that, or we would strongly recommend being relatively stable with your portfolio, and then you don't make any big mistakes. So if you, make that adjustment, well, if you just rebalance, then even if you're wrong, that's not really going to hurt you that much. If you move to 55% equities, that's not going to hurt you that much. But if you just go all in, sell all of your fixed income, and then the Fed changes their mind or something, then you don't get blown up. Because it's important, what I think most kind of younger investors are missing, that like kind of 3/4 of the battle is not blowing up and staying
right.
And so if you buy too much Bitcoin at 60,000, that could be a huge problem. But if you have 1% of your portfolio in Bitcoin, or a half or quarter, buy some at 60, then you have some firepower to buy at 30 as well.
Right.
So kind of portfolio management, risk management, keeping modest position sizes, having yield. And obviously, if you look for yield, then you wouldn't have a lot of Bitcoin, right? So these things can avoid blow-ups, which I think, like I said, most of these less experienced investors don't recognize. It's sort of arithmetic. If you're down 80%, then you have to be up 400% to get back to break even.
Yeah.
So that's kind of an arithmetic you sort of have to live through. But that's why we counsel kind of moving slowly, dollar cost averaging, being diversified, and keeping your position size. Like for less risky securities, 5 or 10%, like in asset classes like preferred, you could be 5 or 10%. But certainly risky stocks, you'd be kind of want to be 0 to 1, maybe 2, but not any more than that. So the volatility should impact your allocation.
Yeah, you brought up a great point about I call it negative math. So in case viewers didn't follow what you just said, is if you're down 10%, you need an 11% gain to get back to even. If you're down 25%, you need a 33% gain to get back to even. If you're down 50%, you need a 100% gain to get back to even, so on and so forth, right? If you're at 10 and it goes to 5, you're now at 5, it's got to go up another 5, which is 100% of 5 just to get back to 10 where you were.
Yeah, preservation of capital, whether it's on your whole portfolio or on an individual asset class, like we counsel people on energy and MLPs a lot as well. And we just point out, well, that's a very risky asset class. So that if you normally, in an asset class, not a stock, but an asset class, are at 5, like 5, it's pretty reasonably 5 to be 5 or 10% utilities, because they're guaranteed by the state government their return.
Right.
But if you're 5 or 10 in utilities, then that means, and energy is basically the riskiest sector of the stock market, then that means you should sort of be like 0.5 to 2% MLPs and take advantage of the volatility. So, dollar cost average in, you're 1%, and then you get a 50% drawdown, then you have some powder to double your position. But if you were at 10 or 20, then you just are sort of blown up. So I think those, allocation rules are critical to controlling risk.
You know, I mean, absolutely fantastic point. I can't stress that enough because I know it applies to both individuals, but it also applies to institutional investors. And I know a large portion of our audience are institutional investors. So would the same rules apply to them or the same guidelines?
Well, I mean, I think it's kind of obvious. Like, so there was the huge hedge fund blow up, which was sort of just, if you took what I just said and did the exact opposite of it, then that's basically what they were doing. So they had massively, well, and of course, most people don't have the problem of creating illiquidity in their positions because they're not big enough. Right. but I mean, I would add that if don't trade in illiquid securities, period.
Yeah.
So then that's the same point, is that if it's getting illiquid for you, then just have less, and so that is liquid. So they not only did they do the opposite of everything I just said, but they're also massively in illiquid positions because they're so gigantic. So they were all basically in equities, and in fact, a lot of them, I guess, were in the same sector, and they had huge positions and huge leverage. I didn't mention leverage, but of course, that's another thing. You should keep modest or zero leverage. And so it's absolutely reigns, and you would think that all hedge funds would follow this, but not only in the case of that the liquidation by the prime brokers of that concentrated fund, but you also saw it in short selling, where shorts are a little bit like energy stocks. They should have very, very small positions, so if they double, so if you're short, I mean, most good short sellers have kind of like 0 to 1% shorts. So if they go against them, they become 2%. If they're 5%, they can become 50 if they go up an infinite amount. So it's even more true on the short side. We don't do that in our funds, but we hedge with ETFs and options, but in our private funds, that is. And so the same rules do apply, and you would think that everybody would follow it, but isn't always the case. We are concerned about 22, not just because of the taper, but it's pretty unique time in history where you likely have quadruple cliff. So you have a fiscal cliff coming just because we've overstimulated this year. You've likely got a monetary cliff, maybe even an interest rate hike in addition to tapering. We haven't seen it yet, luckily, but potential for tax increases, and then most likely higher oil prices. So we're cautious about 22, but we'll probably just have stagflation and not a recession. So could be a decent market for stocks, but it is one reason why, in addition to the taper, we think that the stock market's a little dicier now than it was when we spoke to you last 6 months ago.